the project which was started in Madhya Pradesh. So just read this. Who's going to read? Ashta, can you read this?
REWA Ultra Mega Solar Limited, commonly known as RUMSL, was formed in July 2015 as a joint venture between SECI, Solar Energy Corporation of India, and Madhya Pradesh Urja Vikas Nigam Limited, MPUBL.
So these are the two bodies which came together and they formed an agency, a nodal agency, which will actually, allot this project to various sponsors. Okay. So RUMSL was created specially as a project implementation company. So this was an implementation company, which means that it did not generate power itself, but acted as a nodal agency responsible for structuring, tendering, and implementing the project. Okay, fine. Then, with a technical and transaction advisory support from International Financial Corporation (IFC), so this body conducted a competitive auction in 2016, where the developers bid. Developers are basically the sponsors or the they form the SPVs later on, where the developers bid based on the lowest tariff they could offer. Now, they were asked to quote a lower tariff, how much tariff they are going to charge. There, Alan? Who's there? Just listen, please. Okay. So what the bidding was done, the bidders were asked to give how much lowest quotation they can charge. At what rate they will be able to sell their power to the off-takers. Okay. So whosoever offered the lowest got the contract. So one of the large, okay, read please, Ashta. Ashta, yeah. आपको बोलो. You're Ashta, ना? ये आपका नाम ही तो है और आप गलत जगह तो नहीं बैठे.
I heard Asia.
Okay. और Ashta भी है, Asia. अच्छा तो. Oh. I can't see basically the name there. I can see your name only. Where's the read?
One of the largest single-site solar power plants in the world.
So one of the largest single-site solar power plant in the world.
Capacity is 750 megawatt, 3 units of 250 megawatt
each. So that means, this is broken into three separate businesses, okay, each run by three different companies. So area was 1590 square hectares of land, which they purchased, bought, the government allocated for this project.
Location is REWA district, Madhya Pradesh. And commercial operation since July 2018, full 750 megawatt commissioned on 3 January 2020. So
on 3rd of January, it started operating, started producing power. Record-breaking tariffs. Okay.
First year tariff was 2.97 per unit. Levelized tariff was 25 years is rupees 3.3 per unit, achieved without any viability gap funding, which is called VGF, significantly lower than prevailing CPSU backed solar tariffs, approximately 4.5 per unit at that time. So, the first year tariff, which was quoted lowest, was 2 rupees 97 paisa. Whenever we purchase power for our houses, how much price we are paying? To the extent of 7 or 8 rupees. Depends upon state to state, place to place. So 7 to 8 rupees we pay for the normal power, okay? Fine. And they were being, they quoted 2 rupees 97 paisa for the first year. And then a levelized tariff of 3 rupees 30 paisa. So that means every year it will go up by certain, and the overall average tariff for the entire 25 years was 3 rupees 30 paisa. Achieved without any viability gap funding. That means the government never gave any subsidy to this project to, fund this project. So this was based on without any, any major subsidy coming from the government. It was much lower than the other projects which were being started and up to now, done by the central, power public sector undertakings, which was the rate was to 4 rupee 50 paisa. So this was the lowest. Okay. Strong competition and global participation. The companies participated in transparent international bidding.
So there are 20 companies from France, from Italy, from Singapore, from Japan and Mauritius, and some more. So these were, the international players along with the Indian players. So they all participated in the project. So this was the final, people who were selected, who were given the project. Okay. Each developer awarded 250 megawatt capacity. So these are the three companies, they were given the projects to establish power plants in that land. Okay. So innovative power offtake structure. Just read this.
Two power procurers. Madhya Pradesh Power Management Company Limited, 76% of power for MP DISCOMs. Delhi Metro Railway Corporation, approximately 24% of power. Introduced innovative energy contracts instead of conventional PPAs for portfolio-based multi-buyer contract structure.
So here they use the word innovative, which means that it was a portfolio-based multi-buyer power contract structure, where it will depend upon the power will be given to Delhi Metro and to the DISCOMs based on their own requirements. Okay, so it is not kind of a fixed thing. So you can read more about it on the Google, so how it was done. But this was a portfolio-based multi-buyer contract structure which they formed, where it was based on the portfolio. How much will be taken by which body. Okay.
Enabled optimum scheduling, meeting approximately 60% of Delhi Metro's daytime energy demand.
Okay, so this was based on this, parameter that it will take care of 60% of the power demand of Delhi Metro at the peak time. So based on that, the power agreement was done between the two, bodies. Okay.
So the power supplied for rail traction, a first time in India.
So the first time, this was given to the railway body. Okay. Now the low cost financing. So CTF loan is okay. CTF is basically Clean Technology Fund. It's a multilateral climatic fund under this thing. So they gave a loan for 40 years at the rate of 0.25. It's a foreign currency loan. The rate of interest was only 0.25. Okay. World Bank concession loan for internal infrastructure. So they also gave loan, World Bank. Then the IREDA, another, a kind of a body which also, financed this project, resulted in a very low solar park charges, a key factor behind the record low tariff. Because the rate of interest, the cost of funding was so low that they were able to quote a low rate. So it was not that they got the, because it was, going to help, to produce a clean power, eco-friendly power, instead of, using coal and other kind of hydrocarbon, which pollutes the environment. So there were bodies who were, world bodies who financed it at a much lower cost. Okay. So this was a lender-wise loan amount, which they, how much money they got. This is all available on the net because they again keep differing from. If you just choose a different place, you will get some other number also. So I've tried to capture all the numbers from my research, but I couldn't get a complete, picture where I'll get all the numbers because the rate of interest was not given. Because the World Bank exact rate was not publicly disclosed. Okay, if you see the rate of interest there, then the IRED, again, the rate of interest was not publicly declared. The World Bank refinancing scheme. Okay. Then this was, the lenders, the Clean Technology Fund, the World Bank. Okay. And so you can just read this of your own. There's a lot of this thing, right up here. Then the global recognition. Just read.
Winner of the World Bank Group President's Award for Innovation and Excellence, recognized by the Global Infrastructure Facility as a model project for optimal risk allocation, attracting multilateral banks and institutional investors, infrastructure development in emerging economies.
So this was, given a global recognition. They were awarded a Group President Award, the World Bank Group President Award to this project because of the optimal risk allocation, attracting, multilateral banks and institutional investors. Okay. Then why? Yeah, just read this. What was the optimal risk? Yeah, optimal risk. Yeah. So I have already explained that, all the risks were actually done through various contractual agreements. So they have entered into an EPC agreement with Larsen Toubro, and all O&M agreements were there. Off-takers, customers, they have tied up with the customers for whatever production would be there. So that was the optimal risk. There was hardly any risk in this project. So lenders were very happy to lend even at a low rate. So they were assured about that they will be getting their principal back and the interest also. Okay.
Set a new benchmark for solar tariffs in India, demonstrated viability of large-scale renewable energy without subsidies, became a template project for solar parks across India and globally. Okay,
fine. So this is all basically self-explanatory. I'm just running through. Okay, so this was, ultimately, okay, read.
At the end of the auction, the 750 megawatt project was divided into 3 units of 250 megawatt each. Unit 1, Mahindra Renewables Private Limited. Unit 2, ACME Solar. Unit 3, Sol Energy Power, part of Actis Solar. These three developers emerged as winner and become sponsor for their respective project units.
Okay. Now, this was the target. This was the, the power rate which was quoted by each of the SPV or the sponsors. Okay. Like Mahindra quoted 2.979, so they got the award. Acme gave 2.970, and Adson or whatever name is 2.974. So they were the lowest. Okay. Acme is basically a Gurgaon-based company, I believe. Okay. Have you heard about this Acme company? Okay. So this is a company called Acme, which has some telecom links, and I worked for about just 1 week in this company. Okay. That was my last company. After that, I left the corporate job. I didn't get my letter appointment also. So I went there. Then I found there was a lot of traveling from my house to this company. So I just stopped going after a week. Okay. Okay. Now this is, just read this.
This was the first large-scale renewable energy project in India where solar tariffs reached grid parity, meaning solar power become as cheap as conventional grid electricity.
So if you look at, these are the, the rates what I pay in Gurgaon for taking electricity from there. These are the Gurgaon rates where we have to pay, like for every 500 above units, we have to pay 7 rupees 10 paisa. Okay. Okay, read this.
There was an escalation of 5 paisa per unit per year for the first 15 years, after which the tariff remained fixed. On a levelized basis, the tariffs work out to around 3.3 per
Kilowatt
kilowatt
per hour.
per hour.
3.3 kilowatt per hour. That means 3.3 per unit.
Yes.
Okay.
Or approximately 4.9 US cents per kilowatt per hour.
Okay. Is that okay?
The REWA Ultra Mega Solar Power Plant, with a total capacity of 750 megawatt, is one of the largest single-site solar power plants in the world. It is located entirely within Madhya Pradesh, which made land acquisition and evacuation planning much easier compared to fragmented solar projects.
Okay. So, government gave us support. Okay. So, EPC, the Larsen Tubro was given the EPC contract. Just read this.
Larsen Tubro was selected to deliver EPC services for all 3 units of the REWA solar park. The project was completed within a tight timeline and was fully commissioned in 2019, roughly 2 years after the auction.
Okay. Right. So I'll come back to this case study again. So we are going to do some question. Okay. So that you can all get involved. Okay. Okay. First, we'll just understand some simple questions and then we'll have an exercise which you people will be doing. So just read this question. Who is going to read? You're going to read? Okay.
Special purpose vehicle is developing an infrastructure project financed through the project begins operation in year 1. Year 0 is construction and has no operating revenue. The project has term loan repayment over 10 years, year 1 to year 10, with the following projected operating and debt service data.
Okay. So this is the information which is given to you. Okay. This is for the next 10 years. How much revenue this project is going to make? What is the O&M cost which is given? Interest is given and principal repayment is given. So these 4 things are given. Okay, fine. This is the simplest form of the information which is to given, and we have to calculate the debt service coverage ratio of for all the years. Okay, so the revenue minus the operation cost becomes the EBITDA. Okay, because other things are not given. No interest. No other information is given. The capex and other things, the maintenance capex and other things which we always use. The working capital. Assume there is no working capital requirement. So the interest and principals are given. Okay. So if you combine them, we'll have the total debt service, and the CFAD will be the revenue minus the operating cost. Okay. Ignore taxes, depreciation, and working capital changes. Cash available for debt service is EBITDA for this question. Okay. Compute EBITDA. Okay. Compute the total debt service. Compute the debt service coverage ratio for each year. Okay. The formulas are given, so which I have already explained. This is just the first question where I'm just giving you everything. Okay. Is that okay?
Yeah.
So now, compute the cash available for equity for each year after the debt service. So after paying off, what is left for the equity shareholders, which is basically EBITDA minus the total debt service, whatever will be, that will belong to the equity shareholders. Okay. Identify the minimum DSCR here and comment if it meets the lender covenant of DSCR greater than 1.2. Okay. So you have to calculate the debt service coverage ratio for the information which is given to you. You don't have to calculate. I'll show the answer straight away. When we move to the question, then we will do, you will be doing it yourself. And then one question which is linked to the Excel, I'll be sharing that. Okay. Fine. So you have to calculate the DSCR and say whether it meets the requirement of the lenders. So if this is the answer based on the information which is given, EBITDA, total debt service coming from there. Then we calculate the debt service coverage ratio by dividing the EBITDA divided by the total debt service. Okay. Then the total cash to equity will be the 90 minus 40, 50. Okay. Is that okay? Is this clear? Okay. So let's go to the question now. Let's go to the Excel sheet. Just open the Excel sheet. I've shared the Excel sheets with you. So the Excel sheet name is Project Finance. And in the this thing also, the question is also given in the PPT also after this, I think. I'm just opening the PPT also. So this question is also there available on your PPT as well as on the Excel sheet where I've linked with the formulas. So this is the question. Okay, just read, everybody just read this question in your mind. Okay, first just read it yourself and then we will go to the Excel sheet and the same question is there available with the formula all set there. So the first sheet is okay. So either you can see your laptop or just see what is there on your screen. So this is the question 2, okay, where the capex is 500 crores. And how much debt? 350 crores. And how much equity? 150 crores. Interest rate is 9%. So loan is taken for 5 years and to be repaid in 5 equal installments, 70 crores every year. Depreciation based on straight line method for 20 years. So that means 500 crores divided by 20, 25 crores the depreciation every year. Okay. Corporate tax, 25%. Ignore, assume no MAT. You know what is MAT? Minimum alternate tax. Kabhi kara? Nahin. Okay, just ignore it. Saying ignore, so we ignore at the moment. We'll come back to what is MAT later on. Okay. Ignore expenses, other expenses and income. Okay. Fine. So this is what is given to you. So this is the operating forecast which is given to you. Revenue, O&M cost, maintenance capex, and increase in working capital. Okay, fine. So this information is given to you in the second slide. Then, so some definitions. So it's telling you, how to calculate EBITDA. So I'm just skipping that. You can just for your reference. Okay. Then the questions. Prepare a loan amortization schedule. Okay, number 1. Opening plus interest, opening, interest, principal, closing from year 1 to 5. So this is the schedule you have to prepare. Then prepare a year-wise income statement. Okay. Then compute CFADS, debt service coverage ratio, for each year. Then the lenders requires a minimum DSCR of greater than 1.2 each year. Identify which year meets the breach, which year meets breach the covenant. Suggest 2 structural fixes to improve the debt service coverage ratio. Okay, so this is the question in entirely. Okay, now we go to the Excel sheet. Fine. So this is the question. And if you look at this, so this is again the question. These are the, the individual questions which have this thing. And the answer is on the A2. Okay. So this is the answer. So original debt, if you look at the debt is how much? 350 crores. Okay. Is that okay? Then the interest is how much? 9%. So which is basically, if you look at the formula, and so it is basically 9% of 350 crores, which is 31. And principal is 70 crores. We know that it is going to be paid in 5 installments, 5 yearly installments. So the closing debt will be 280. So what we have to do is we have to just calculate in the opening balance 350 minus principal 70, the closing balance. This will become the opening balance on which we are going to calculate the interest. Principal remains same. ये एक्सेल शीट नहीं है, तो मैं आपसे पूछा, आपने बोला है. Okay. I'm just going to share that. So it is section A, B, A. Which one? A. Just go through this video also. Very good. Okay. So this is okay. The file name is Project Finance. Okay. Okay, so this is the file. Okay, so now you have this thing. Okay. So this is the answer. The question was there, which you have seen already. So what you have to do is you have to make a loan amortization schedule. Is that okay?
Yes.
Is it okay? So this you have already made. Then we have the income statement, which will be the revenue, coming from this file. Revenue diya. I've just made a link here. Okay. So revenue for all the years linked from the question file. Then O&M linked to the question file. And this minus this is EBITDA. Okay. Then we have the depreciation, which is 25 crores, which is, given in the question. Again, which is linked to the exercise. Number is given, cell reference is given. Then we have the EBITDA. Then interest is coming from here. Then we have the tax, which is 25%. Okay, so calculated the tax at 25%, which is again given in the exercise. Link is given 25% there. Then we get the PAT. Is that okay with this? This is the income statement which we have prepared, taking the income, the revenue, then the O&M cost, which is given the question. So we minus the revenue with the O&M, we get EBITDA. Then we calculate the depreciation, which is 20 years for entire project. So divide by 20, we get 25 crores as the depreciation. Then EBITDA minus depreciation is EBIT. EBIT minus interest is EBT, earning before tax, then tax, and then the PAT. Is it clear to everyone? Anybody who has not followed this, please ask the question, okay? Are you with me, everyone? Anybody who has not followed, you all know this. This is a simple income statement, okay? Then we calculated the CFADS also. So we picked up the EBITDA from the first sheet, from this sheet only, tax, maintenance capex, change in working capital, which is given the question. So we arrived at CFAD. Then interest is there. Principal repayment also is there in the question. Then debt service rate, that total debt service, interest plus principal. Then we calculated the DSCR. Okay. Simple formula linked. Okay. Now tell me, what was the required debt service coverage ratio in the question? So is it meeting in every year? It is not meeting. It is a breach in the first year, second year, third year, fourth year, fifth year. It is only meeting. Okay. So so fixes basically. How do we, how we can fix it? So breaches 1, 2, 3, 4, which is less than itna, meets only 5 year. 2 structural fixes. Any 2, okay, to earn marks. Debt sculpting. Okay, fine. So decide, how the debt is going to be amortized based on the debt sculpting exercise. So you can do that. Back-ended principle. Suppose the company is earning more, so you can have the more principal at the end and do the debt sculpting. So it will solve your problem. Okay. So this is one. Is that okay? Second, increase the loan tenor. That means you increase that loan period. So it will, you can meet. So that can be, some suggestions. The third is, so to cover typically 6 months. So this is the debt service reserve account. So you suggest that the reserve account should be maintained so that the company is, providing a debt cash balance or a bank balance is earmarked only for paying the debt, the loan and the principal. Grace period, moratorium period on the principal during the initial periods. Okay. I think somebody asked you question. Okay. What was your question? No, your question was that, in the initial periods, the company is not making any income. So how do the companies finance this thing? That was one question, isn't it? Oh, that was your Akriti. So just read this. So, the banks generally give, a grace period or a moratorium period on the principal during the initial years. That means in the time when the company is under construction, okay, company will start collecting money only when the plant becomes operational. If you're not making any revenue, okay, they will charge interest, but you have to pay it only. They'll not collect anything from you. They'll collect only once the company starts making money. Okay, the company is generating revenue. Say 1 year or 2 years, there is a time when if the construction is on, so company cannot pay anything. So that will go into that the loan will start only, whenever you take a loan from the bank for making your house. So it takes about 1 or 2 years to make the house. So they'll start the installment only after you are, capable of paying it. Okay. Fine. The house में तो आपको कोई earning नहीं होती, but they give you a moratorium period sometimes. Is that okay? Your question remains still unanswered. Okay. Then higher equity contribution to reduce debt. So the sponsors, they can bring more, equity and reduce the debt so that the debt is less. So it will be able to meet the ratio also. Is that okay? Fine. So there can be various suggestions which you can give. So what are the suggestions? Kya suggestions? Can you just, what are the suggestions? What are given there? So this is the question which is available here. Just go through. Have you got the now Excel sheet with you?
Yes.
So ये question कीजिए and solve it on an Excel sheet and share your answers. Once you have, no, it's like this. आप कर लो. Then just you decide, show it on a projector here and explain to the class, a group. whosoever does it, उनका class marks जो है, they will be assessed on, on one of the internal evaluation will be checked for them. So 2 or 3 students can make a group and say that we are going to, show the answer and share this thing. So it's a 10-mark exercise for that group. Okay, for them, this will be done. So similarly, I'll give you another question. So then we will form groups out of this thing, and they will come and share their answer, and then the class will. So based on that.